Ladies and gentlemen, please welcome to the stage Richard Quest, anchor CNN.
Hello. Right. You're here. Everybody knows where they are. Very good afternoon to one and all.
Perfect.
We have with us today, we have Lieve Mostrey from CEO of Euroclear. Forgive me for mangling your last name, I apologize. It won't be the first, so not the last. Next is John Studzinski from the Vice Chair of PIMCO. Good to see you, sir. Yes.
Yes.
I think your chair might go up, but I'm not sure.
If you do this, you can hit
Did you discover the button?
Yes.
Oh, wait a minute. It's on the right side.
Yeah.
There we go.
This is like Alice in Wonderland.
On the right side, you can go further. Andre Esteves is the senior partner of Banco BTG, and Ken Moelis is the chair of Moelis and Company. The panel discussion is on debt. John? Debt. Geopolitics and debt, how to prevent the next financial crisis. The only thing I keep hearing from everybody is that the financial world is worried about the large amount of debt out there that's been taken on, particularly by emerging markets. And let's not go into the reasons why. There were valid reasons for taking on the debt, but now it's too much. Go ahead.
Richard, thank you. I think we have to pause and remember this conference and this period in history, because I look back on the financial crisis in 2008, where the world was very much joined up, and it was a major crisis, you'll recall, that dealt with liquidity and counterparty risk. But what was impressive is the world was joined together as one. The United States, the Fed, the Bank of England, the ECB, the People's Bank of China, the Bank of Japan, they spoke daily, and the world financial institutions were coordinated. And that, to a certain extent, was the beginning of what we called at PIMCO, Richard, the new normal. We're here today, and the new normal has come to an end. And this is really, and it's very much timely with this conference, the age of transformation, heralded by brown to green, digital, and a redistribution of wealth or common prosperity. So while there is a lot of debt in the world, to your question, it's putting a lot of pressure on monetary policy to become a little more measured, and it's going to challenge whether fiscal policy is going to have a role.
We'll come to that. Sir, too much debt at the moment.
I think I'm not so worried about specifically on that, but I would say that worries me more is the anomaly on fiscal and monetary policy. And in order to make a response of managing the overall global debt, I would say the normalization of monetary policy should be the first step. I think we are considering inflation transitory. The central economies are growing above 5%, inflation is above 5%, and we are still practicing quantitative easing in most of the economies.
Right. I'll come back to that, but I want us to stick with that for 1 second, if I may. Yeah. Because the fear is that, particularly for emerging and developing economies, the debt that has been taken on, for whatever reason and however justifiable, becomes unsustainable towards a normalization of policy?
I don't think so. I think that is manageable as long as you produce sound economic policies, right? Of course, overall global levels of indebtedness are higher, which means that we need to be more responsible, fiscally speaking, on the medium and long term. So having said that, I think it's manageable.
And what I would add is that it matters a lot to which purpose the debt is taken on. And I think it is specifically interesting to make that point in this country. This country has huge infrastructure projects, has huge financing initiatives to modernize and to transform the country, and taking on debt to that purpose, it's not a problem in my view. In my view, it is something for which the international investors are very interested in order to invest in that type of infrastructure project.
Right, this is the idea that debt for investment is obviously good versus debt for consumption.
Exactly.
But why is it on questioning business, again and again and again, I have people like the World Bank and the IMF saying we are now starting to be concerned at the level of debt indebtedness because, remember taper tantrum, that's not going to happen, but something similar could.
Well, I think that's because once you give somebody a job to worry about something, their job is to worry about it. So that's what they're going to do when they talk to you. But, you know, I do think it's very interesting when you talk about debt today. You know, 5 or 6 of the largest companies in the world have zero debt, or almost no debt. Aramco, Amazon, Apple, Netflix, Tesla.
Alphabet.
So this idea that you need debt to fund, what's spectacular about the world today is that they're willing to give tremendous value to growth and equity. And I actually believe it's the wrong time to be taking on debt. And let me just say one more thing, Richard. You know, this is, in the US at least, I've heard this cash is trash thing because it doesn't have yield. Cash is an option. People don't realize being debt-free and having a very healthy balance sheet, whether you're a country or a company or an organization, is an option on uncertainty in the future. It's a very valuable option. When adversity hits, you can't go backwards at that moment. So I do think this whole idea of people taking on debt to maximize the rate of return on every incremental dollar is a very large mistake, and you lose the optionality to take advantage of big opportunities.
Right, so the French finance minister, Bruno Le Maire, John, said to me, why would I not borrow? I'm borrowing virtually at negative rates or barely positive rates. Why would I not borrow for infrastructure? And that is the current debate in the US, isn't it? Why would I not borrow more for infrastructure at these rates?
Yeah, Richard, I think people are now focused very much on other ways of, to Kenny's point, growing the economy, and they're not. Everyone knows borrowing is, money has to be paid back. Everyone knows that the fiscal stimulus we've just undertaken over the last 2 years has to be paid back. And you can find different ways through inflation of trying to manage that. But the reality is, borrowing doesn't necessarily resolve it. You've never become wealthy through borrowing. Remember that. I mean, people forget that. People think borrowing is just postponing. It's a form of reallocation in the short term. It's not necessarily creating wealth. So interest rates are low, and interest rates may well stay low, but we all know they may rise slightly, but they're not going to rise because there is 3 times more debt today than there was at the time of the financial crisis in...
I mean, that's a very worrying statistic.
Well, it's a general statistic. It's somewhere around 2.5, 3 times. But that's an important statistic just not to forget. And it basically supports your whole line of questioning.
I think a straight answer for your question should be because one day rates will not be zero.
Yes.
And it will happen.
Right.
For sure.
And what I'm hearing now, and it was at the annual meetings a couple of weeks ago, is that there is a general expectation that there will have to be a restructuring of many developing economies' debt, write-offs, re-extensions, whatever you want to do it, but there's going to have to be a come-to-market moment for debt. Do you agree?
Not necessarily, because first, let's divide sovereigns and corporates. I agree with Ken's comment that if you look at corporate debt overall, I don't think corporations in the world with high levels of debt, historically speaking. I would say quite the opposite. I think corporations are in a healthy balance sheet at this stage because people made money in the last period or the last cycle. Going to sovereigns, I think, again, the issue is less the picture about that, but it's the dynamic, how you manage your macroeconomic balance sheet, right? So if you have sound fiscal policy, you can live with higher levels of debt. If you have irresponsible fiscal policy, you cannot even afford lower levels of debt. So I would say that the economic Bible is very well known for everybody right now. And
so how concerned... Yeah.
But Richard, one of the things that bothers me about your line of questioning is you're treating debt like it's its own little universe. And we're spending a lot of time in this conference talking about infrastructure, investing in green. We're talking about the digital transformation and how the emerging world has been changed a lot, particularly during COVID, in the use of technology and Wi-Fi and communication. So you've got to look at these economies that we're talking about, even in places like Africa and Southern Asia and Latin America. They're all being transferred with many things happening simultaneously, not just the issue of debt.
I agree. Go ahead.
Yeah, and maybe I would add and flag also the different approach that the European Commission is taking now. After the financial crisis, we saw that the reaction was mostly austerity. We don't want to add debt. And it has created its problems of its own, what we have seen in Greece and the likes. And now with the new EU, the next EU programs that will issue 800 billion of debt, mostly looking at infrastructure, digitalization, healthcare, and climate, I think this is an approach that has all the merits.
But the mutualization of debt through the EU, which is what we're talking about here, was highly controversial.
It is highly controversial for a number of reasons, but I think it has great prospects as well. And we
Until they come back for a second and third tranche.
And we see that investors are very attracted to it. The latest green bond of the EU, 12 billion that was issued, had an interest of 135 billion for it. So there is a lot of demand also. There is willingness to invest in these instruments.
I'm more skeptical, bordering on cynical than the rest of you. Born out of Latin America debt crisis, African debt crisis, Paris Club restructuring, London Club restructuring, and everything I'm hearing, Ken Rellis, is that there's another restructuring going to be required. I take your point, John. I take your point. But I wonder, even though it's designed for infrastructure, has too much debt been taken on? Either of you?
Well, can I say one thing? I was sitting at dinner last night with a large regulated bank, and they were talking about how the regulations today, daily P&L, daily risk management, daily monitoring, and I was thinking, it's completely, so what happens is you solve the crisis of 10 years ago, and then you turn it into a crisis of the future. I said that for risk management, there was not one question, how's your client relationship? What's your reputation like? Who are you dealing with? And I continue to believe that relationships and the quality of the business you're doing are the most serious risk management tool you have, but that's impossible. That's all I ask. Every day at the firm, I ask our bankers, how are we doing with our client? How's our relationship? And the rest takes care of itself. So I do think we're chasing the metrics of 2007 to try to stop the crisis of 2025, and I don't think, as usual, they'll be looking in their rearview mirror.
So if we are at risk of doing that, what is the crisis that comes, what is the financial issue, in your view, that comes out of the pandemic crisis? Assume the pandemic lasts, whether it's another year, 18 months, 6 months, whatever. But as we come out of it, What is the overhang financial crisis that awaits us?
Richard, I think the topic of this panel is also debt and geopolitics. And I think since, to Kenny's point, since 2008, the whole allocation of debt with the World Bank, the IMF, and all the supporting of the emerging markets has taken on a decidedly much more political taint. I mean, this is not the 50s and 60s where there was a much more arm's length relationship. You've got the role of the Belt and Road Initiative in certain parts of the world that the Chinese government has played. You've got the evolving controversy around debt that's being provided by the World Bank and the IMF. So this has become, in the last 10 years, very political. And it's not nearly as straightforward as people...
More dangerous if it's more political.
I don't know if it's more dangerous. I don't know if we can make...
Risky.
Can you make that generalization really about... Because it's going to be different country by country, economy by economy, industry by industry.
Okay. I see what you're saying, but if it is more geopolitical as a result, what is the risk of which we need to be aware because of that?
I think there is a clear one, inflation. And from two causes of inflation, a microeconomic one, which is disruption of global supply chains, and two macroeconomic ones, very expansionary monetary and fiscal policies all over the globe. Inflation is probably is helping debt management in developing countries because now most of developing countries have negative real interest rates for the first time in 1 century. That's why debt is manageable during this tough period. But on the other hand, not only in developing countries, but also center economies, I think September was the 4th month that inflation is above 5% in US, UK, German, emerging markets. So it's something new for our generation of financial players.
Is that a concern?
Relatively new. Is that a concern? Definitely is a concern.
Is it a concern?
I think it's an attention point, and we will have to make sure that we can, with our investments and our debt, also support productivity increase. If it comes together with productivity increase, the risk is more manageable.
But Richard, it goes back to what we started with is very different investment period here than we've had in the last 10 years. Much more volatility, much more dispersion, much more division, much more disruption. And it's all coming from the fact that you're going to have periods of inflation, as Andres talked about, but you're also going to have periods of disinflation or deflation, which can be helped as more technology becomes ensconced in certain economies. Because technology has been known to be disinflationary or deflationary. We know that. So you've got these two things working against each other. But as we invest more and more in green, there's going to be a short-term increase on inflation, jobs, and demand. But we're also seeing the short-term implications on supply chain and goods coming out of the pandemic.
But do you believe that the current inflation is transitory?
I think it's a dangerous assumption, even though that it's a possibility, but assuming that it's transitory, I think could be eventually
That's
a
exactly
monetary
the
policy
assumption that the Fed is making, the ECB is making, Bank of England less so at the moment. What do you think, John?
And we don't think it's any more transitory. I've heard a term last week. It's sustained transitory, which sounds like a great contradiction. But I think it's inflation in the short term, the next couple of years, is going to certainly, there are more things that are going to keep it up than down. And I think we just have to keep that in mind. The notion of transitory, I think I don't think you'll be asking that question in a month's time, because fewer and fewer people feel that inflation is transitory.
Okay, so if it's not, or if it's quasi-transitory, whatever we want to hedge it with, at some point you can no longer play footsie with it. You have to deal with it. When is that moment for you?
Well, look, I think as we get out of the pandemic, I think, you're talking geopolitically, I think there's a big risk. After we've had We haven't had a major war, a world war, in a long time. This was a war. This was the equivalent of a world war. 7 billion people put their head down and all did what they were told for a while. I happen to believe some of the transitory inflation, and one of the biggest risks I see is when we step back from this, there is a whole group of people who suffered greatly, middle businesses, mid-market businesses. I think there'll be a reevaluation of how the response went. And I think that'll be very unstable. People are going to look back who lost their businesses, their jobs, their livelihoods, and they are going to ask the question, why? And was it appropriate? And I actually think if you're looking, and I think, by the way, the transitory inflation is part of almost a labor strike going on around the world right now as people have enjoyed universal income without going to work. And I think we're going to see a lot more of that than anybody's even envisioning right now.
I'm going to put that in the back pocket for 1 second, because that's an area that we'll come to towards the end, this idea of what happens next. If we look, though, at the financial instrument du jour, which seems to be some version of crypto. Now, your exhalation, John, suggests that you're more Jamie Dimon.
I'm going to pass on this one and defer to my colleague on my left, who is more articulate on this than I am, because I think you know my view on this.
Are we being fooled by crypto?
So my colleague says that I'm more in this, but I think we have to make a difference between the technology and the use and some of the use cases. Yeah. I'm an engineer. I'm very interested in the technology. I think the technology has potential. We have done a number of tests. We have done a number of experiments. And we can see in the world of finance where we are active, we can see as advantages efficiency, and we can see more transparency. I'm sometimes asking myself the question whether within a number of years we will not regret that Bitcoin was the first use case of blockchain, and maybe has with that negatively affected the reputation of the technology versus a very speculative instrument.
Yeah. In other words, blockchain is very good. It's a shame Bitcoin's given it a bad name.
You can call it that way.
Yeah, no, that was a good summary, I think.
But that seems to be a common view, doesn't it?
I think the common view is that certainly the technological infrastructure that was built or were born together with the cryptocurrency certainly will be extremely useful for the next decade, and probably will promote a revolution in how we play finance globally, right? In a positive way, increasing productivity, facilitating remittance, settlements, the whole decentralized finance world, I think, is here to stay.
Are policymakers right as we look to the next crisis, which is, as you say, we're very good at fighting the last one after it's over. Are policymakers right to be regarding crypto as a structural risk, a systemic risk, I should say, to this system, which seems to be what they're dancing around as they talk about regulation, to avoid that and to make sure widows and orphans don't.
I think our policymakers are right in protect a system that took about a couple decades to be very efficient about anti-money laundering, about monitoring financial risks, global stabilization. So it's not about the innovation, it's about adapt innovation to a setup that now is quite efficient in terms of giving us a better place to live. So that's the words of the regulators and policymakers, and I think they are with the right words. So it's how to adapt to a functional framework that took us a few decades and a few crises to achieve and to arrive here.
On this morning's panel, I was aware that all the major banks there, and I suspect the same here, have all reported bumper, brilliant, superb results at some shape or form in the post-pandemic, or since things have reopened. But I wonder, does this just not make the disparity, the inequality, greater that we're supposed to be, that FII is supposed to be talking about. That we're actually coming out of this crisis in a much worse state when you talk about the significance for humanity. Start with you, Ken.
No. First of all, I announce my earnings tomorrow, so I don't want to confirm or deny anything you've just said.
You have a pass.
I don't want to.
You have a pass.
I have a pass. But no, I don't. I think the creativity and the value creation in the world, I think you go back 20 years ago, we had billions of people that weren't participating in the economy. So we didn't measure the wealth of a lot of Asia, and and India was an emerging. The amount of people being brought out of poverty into middle-class lives by the tremendous mechanism of capitalism and our ability to deliver products and services at a spectacularly lower cost is amazing.
Right, but then how do we protect? How does FII, in the way it's been, the issues we're talking about, how do we protect those gains at a time of vaccine inequality and growing inequality?
I'll let everybody, but protect capitalism with your life. There would be no vaccine without capitalism. Without letting the private sector go at it, we'd all still be meandering around some hall in Congress in the United States picking a team to look into it. But instead, somebody motivated a bunch of companies and they went out and solved this crisis. A long way to solving this crisis. And for all of the great initiatives we have, if you want to bring people up to more equality, protect capitalism with your life, and everybody in industry should be doing that.
I think, Richard, it's also, we're going from a period in the last 10 years of low interest rates, low inflation, robust growth, a strong equity market. It was a very, very sort of happy time in terms of growth. And as you rightly say, there's a period of the populations in the world. Everyone's done better, but there's a segment of the population that wonders, have we been left behind? So I think now what you're seeing this in China with the Confucian term common prosperity. You're seeing it in the United States with the swing to the left in terms of, and you're seeing it here in Europe, and we're discussing it here at the FII, this whole sense of not growth, but stability, political stability, social stability, and most importantly, economic stability.
Which is not surprising, bearing in mind what we've just come through.
It is not surprising at all, and I do believe that inequality is an attention point. It is an attention point that governments really have to take the right fiscal initiatives to, in a moderate way, not excessive, but in a moderate way, try to manage that. I would add to that also between countries, there is inequality, and I think the financial system can help to that. We can help by creating more level playing field across new emerging economies and the developed economies for access to investors' money to make sure that everybody can enjoy the same advantages and have the same investment programs to their availability to address inequality as a problem.
A more personal question to each of you, because you're all very senior, leading institutions, responsible for the livelihoods of others, in a sense. What did you learn about yourself during the pandemic, in the way you went about your business, the way you went about running your business or your... And please, you are not allowed to answer about how wonderful your colleagues were. This is requiring you for a philosophical, psychological, therapeutic answer. Right, there we go. Come on, who's going to take it first?
Before going to this question, I want to go back to inequality, because we talk a lot about that without being very objective. I'm much less worried about the results of company X or Y, because there are clear macroeconomic factors that cause inequality on an objective way. First one is inflation. It's the most perverse tax possible, because it's achieved the poor people in a very different way than wealthy people. The second one is high interest rates. That's what we need to avoid from a macro perspective. From a social and political perspectives, equality of opportunities, not necessarily equality of results.
Well, hang on,
That's
hang on. We'll
just
come back to my other
the
question.
link with the
Yeah,
previous
but
question.
hang on. You gave two things that need to be observed: inflation and high interest rates.
Yes.
And at the moment, you've got inflation and the prospect of higher, I agree, nothing like we've seen before, but higher interest rates. That should be flashing red on your dashboard.
Yeah, we need to be very careful because if we consider, if we are too aggressive in our approach to transitory inflation, the middle-term results will be much higher interest rates. That's the issue. And transitory
Right,
is
but
a dangerous word, right? Because if you compare to the geological age of the Earth, it's clearly transitory. But,
but come
it's
on.
not the reasonable time horizon
Right,
of
but
economic policy.
you are just really espousing what has been the central banker's dilemma since the whole thing began, which is, you want to get ahead of the curve, the inflationary curve, and you don't want to raise rates so that you stifle growth. Would you raise rates now?
Yes, I do.
You would.
Yes.
Would you?
Yes, I would.
John?
You don't have a way to go, but you can raise them slightly. You're not going to raise them a lot.
Slightly, very slightly.
You don't have that.
Right, so you're raising to send a really firm message more than to actually expect it's going to have a technical effect.
As long as we come to the reality that we have to stop putting all of our eggs in the monetary policy basket, that has got to stop. Mario Draghi said that when he stepped down from the ECB, and he was right.
Okay.
And we have to rely on much more clever fiscal and other types of,
Not going to happen.
well, it's going to have to happen. And we've already had this shock, and the shock has taught us a lot of things. And we're going to have more shocks if we don't embrace.
Jerome Dieselbaum said at the height of the crisis, we know what we need to do, but we can't get re-elected if we do it.
Well, that's.
And that's your problem. Now, back to you all. What did you learn about yourself?
I think how much all of us here can adapt fast to a completely new environment. It's an important learning.
How did you adapt?
Well, you stay in your home, you work remote, everybody remote, and all of our organizations continue to be functional, all of our societies continue to be functional, and suddenly you don't go out to restaurants, to movies, to see your dear friends. It's a very special moment in history, not necessarily good, but a very...
I think that's a good way of putting it,
teaches
special moment.
us all how we can adapt.
What did you learn about yourself?
I think what I learned is that in exceptional environments where so much things are happening on which you just don't have a grip.
So how did that...
And so what I learned is that you have to do a big step back, be very simple in your strategic goals, and then just follow those. And the strategic goals for us, it was client continuity of service, safety of our staff. And when you have very simple strategic goals, then all your decisions that you have to take, even in a totally unusual environment, come easily.
See,
but you have to do this, taking the step back.
See, I think this is one of the most important things about the crisis, is what we discovered about humanity in its largest, grandiose sense. But also, I ended up broadcasting from home in my living room, setting up the studio every day, having to do... Of course I could do it, but I never thought I'd have to do it for 6 months. And waiting for, doing every bit of it myself. What did you learn about yourself?
Well, the extremes. I learned from a business point of view that you can engage in a cosmopolitan way globally with a global footprint through technology, and you can really get an extraordinary amount of dialogue done in a very disciplined way and very efficient. But I also, on the other end of the spectrum, learned a lot about my monastic self, who likes silence. And I had realized after many years that this was a period where I could spend more time with silence. And I think silence is a very powerful thing. We don't have enough silent moments in the day to pray or meditate. And for me, that was a period where, because we weren't going out every night and you weren't going out every weekend, silence the art of silence, the art of listening to quiet and peace became even more important.
Do you meditate?
I do meditate, yes.
Are you good at it?
I've had a couple of good mentors, and I think I'm pretty good at it, but there's only one or two people who can tell me that.
What I learned, I'm 63 years old, and I learned for 45 years I've been jet lagged every day of my life. And I realized it was different. The first month I slept home in my own bed for like 2 weeks straight. I realized what the rest of the world was up to.
Final question, 2 minutes left. Same question I asked the first panel. As an honorarium from this board meeting, we're giving you either a euro, a dollar, gold, or Bitcoin. You get what, something to put under the bed for a rainy day. Which are you going to take? A dollar, a euro, a Bitcoin, or gold?
The euro.
Well, she had to say that, didn't she? You had to say that, your euro. Sir?
Dollar.
You're going to take a dollar?
Gold.
Gold.
The two big banks would say gold. What do they know that the rest of us don't know? We'll tell you next year. Thank you.